We're diving straight into an analysis report on Navitas Semiconductor, ticker NVTS. It's making a very high-energy, contrarian bull case.
Right, it's positioning Navitas as this hidden AI gem ready for massive growth, even with that recent, pretty brutal 53% revenue drop. And that title, NVTS, the hidden AI gem Wall Street is sleeping on, it sets a really aggressive tone, which I think is great for engagement.
It is. But that same tone, it immediately creates a structural challenge. There's a conflict we need to resolve right at the start.
Yeah, a key theme here is this huge turnaround story. But the analysis seems to present a disconnect in its strategy. We're being told to buy tomorrow for a payoff that's, 3 years out?
The analysis material attempts to bridge two fundamentally different investment horizons, a tactical short-term swing trade and a multi-year growth investment, which fundamentally compromises the clarity and focus of the central investment thesis.
I see exactly what you mean. The report lays out very specific technical levels. It's talking about holding support at $7.30 to $7.40, targeting $8.44.
With a gap fill to 10 plus, yeah. But the core reason to buy is this massive AI data center story that doesn't really kick in until late 2025, maybe even 2026.
So you're asking one reader to watch a chart for next week's trade.
And another to build a discounted cash flow model for 2026. It really just muddies the water for everyone involved.
Wait a second, though. Isn't it okay to argue that the technicals just offer a good entry point for the long-term story? If the trade fails, you still have the fundamental thesis as a kind of safety net.
I see that logic, but the criteria for success and failure are totally different for those two things.
How so?
Well, if you buy based on technical support at $7.30 and it breaks, a swing trader is out. Period. The 2026 narrative is irrelevant to them in that moment.
Okay, right. But for the fundamental investor, that same drop below $7.30 might just be a better price, a chance to add.
Exactly. By mixing those exit criteria, you're forcing the reader to define their own strategy, which is something the analysis report should be doing for them.
That completely reframes the issue. It's not about giving more reasons to buy, it's about defining the reason to sell. So, okay, how do we fix this?
The analysis must clearly delineate which strategy is paramount.
And the suggestion to do that is, what, pick one?
You have to. Enforce that clarity. If the long-term AI pivot is the real story, then you have to get rid of all the specific technical stuff, or, stick it in a footnote with a heavy warning.
Okay, and conversely, if it's really about the short-term technical setup,
then that becomes the star of the show. The long-term growth story gets simplified. It becomes contextual background, maybe a bit of a safety blanket, but it's not the primary driver for the trade.
let's give some concrete examples. So, if we choose the long-term fundamental path,
Then you have to restructure the whole argument to focus entirely on the valuation today.
so the market cap is what, about $1.8 billion?
Precisely. You connect that number directly to the projected high-margin 2026 revenue from AI data centers. You have to prove, with conviction, why today's price is an absurd discount for that future value. Make the short-term noise totally irrelevant.
Okay, that makes sense. But what about the other way, if the short-term swing trade is the focus? That seems, a bit harder to justify in a deep dive report.
It is, but you can do it. You just have to be explicit about the catalyst driving volume right now, this week. Forget future earnings for a second.
So you'd point to, what, short interest?
Yeah, maybe. You could relate that recent 6% pop and the volume surge to current short interest figures. Frame it as a potential squeeze. Or you could reference specific institutional buying you're seeing in recent 13F filings. You have to make the analysis useful for the time horizon it's actually trading on.
Got it. Clarity on the horizon is everything. Okay, so we fixed the timeline. Let's move to the core of that long-term thesis, the tech. The report correctly flags the shift from mobile chargers to AI data centers as the critical pivot.
And it names gallium nitride, or GaN, as the core technological engine for that pivot. It's all about how these new AI servers just eat massive amounts of power.
And that brings us right to our second major critique. While the material correctly identifies gallium nitride as the core technological engine for the AI pivot, the description of its competitive advantage remains too high level, failing to provide the necessary quantitative depth required for a sophisticated investor's conviction.
That's spot on. The current explanation is basically that GaN is smaller, faster, and cooler. Okay, but that's not proprietary.
Right. Every single competitor says their tech is smaller, faster, and cooler. It doesn't tell me anything about Navitas' specific sustainable barrier to entry.
For the report to be truly persuasive, it has to explain why GaN is indispensable for AI infrastructure. Why can't you just use something else? Those descriptive adjectives, they just don't build enough conviction to justify taking on multi-year risk.
I completely agree. We need to strengthen the significance and relevance here.
The way to do that is to translate those benefits, smaller, faster, cooler, into hard financial or operational metrics, things that directly impact the economics of running a massive AI data center.
That's the only way to justify the AI gold rush claim in the title. A sophisticated investor wants to see how the acronym translates to ROI for the data center operator, not just that it's a cool piece of tech.
So instead of just saying cooler, we need to be talking about cooling costs, which leads you directly to power usage effectiveness, or PUE.
Exactly. PUE is the metric that governs cost in hyperscale computing. It's everything.
So to give this material real teeth, it needs to integrate specific data points. They can be estimated or cited, but they have to be there. Show the improvement in PUE that GAN enables compared to legacy silicon.
Even a 2 or 3% improvement in PUE for a big data center operator.
That's millions in savings every single quarter. You have to frame NVTS as a power efficiency solutions provider, not just a chip company.
So for a concrete example, the writer could quantify the percentage reduction in power loss from a GaN-based power supply versus a silicon one, cite some industry averages for efficiency gains.
Or even better, quantify the density advantage. How many more of those hot-running AI servers can you pack into a standard rack? Because GaN's thermal performance means you need less space for cooling.
That's a great point. That directly translates to revenue per square foot for the operator.
And you have to connect the partnerships. The report lists them, but they feel kind of general. Connect them to specific industry standards or efficiency demands that only GAN, and maybe only NVTS's specific version of GAN, can reliably meet.
That's what turns a general tech story into a specific, defensible moat for this one company.
That rigor is absolutely non-negotiable for a contrarian thesis like this.
Excellent. Okay, so we've defined the strategy and deepened the tech moat, but it all hinges on one thing. Can the company actually survive long enough to see this through? Let's talk about risk. The section titled The Ugly Truth.
Right. It acknowledges that 53% year-over-year revenue drop, which, is a complete bloodbath in their old mobile business.
But then it sort of quickly dismisses the bankruptcy risk. It just points to the $151 million in cash and almost zero debt and moves on.
And that's the core of the third critique. The contrarian thesis, while energetic and engaging, fails to sufficiently integrate the profound risk inherent in the massive revenue decline by treating the financial downturn as a past event rather than an ongoing structural cost of the pivot.
It's not a past event. It's an ongoing wound. And the weakness here is that citing the cash balance is just a static defense. It tells me they won't fold tomorrow.
But it doesn't address the real investor concern, which is the burn rate. How much cash are they burning through to fund this pivot until that 2026 AI revenue finally shows up?
The report misses a huge opportunity here. It could proactively frame that revenue loss not as some ugly truth to be excused, but as the calculated cost of acquiring this future high-margin AI business.
Exactly. They are intentionally shedding low-margin legacy sales to fund a high-margin future. But that requires a calculation. You need to connect the cash on hand to the actual timeline of the pivot.
So the suggestion is to explicitly calculate the company's financial runway.
It has to be a dynamic calculation. You take the $151 million, you look at the expected operating expenses, and you figure out how long they can last until those big contracts start paying off.
You need to do the math on the runway. That transforms the cash from just a simple safety net into a quantifiable timeline. It tells the investor exactly how much time management has to deliver before they have to go back to the market for more cash.
So, as a concrete example, the report should show the estimated cash burn per quarter. Let's say, just based on recent filings, their burn rate is roughly $30 million a quarter.
Okay, so in that case, the $151 million gives them about 5 quarters of runway. That's a very specific, actionable piece of data.
Exactly. Then, the next step is crucial. You have to connect that time frame, those 5 quarters, to the estimated delivery timeline for the big data center contracts.
So if management says first big deliveries are in Q3 2026, but the runway runs out in Q4 2025.
You have a serious problem. But if the runway clearly extends past that inflection point, you've just made a powerful data-driven argument for why the risk is manageable.
And that strengthens the whole "the stock is cheap" argument. The price is cheap because the market is pricing in the specific, quantifiable execution risk, not just some vague fear.
Right. It elevates the entire analysis from a speculative bet to a calculated risk assessment. That's what a sophisticated investor is looking for. Absolutely.